host. Oh, I'm sorry. Can you make me host again? I forgot to allow screen sharing.
Yeah, 1 second.
Okay. Ready? Alrighty, let's kick this thing off. Share my screen. Okay. Well, I know we're kind of short right now. I know we have a couple people waiting to get in, and they'll just drop in when we can. I know some of our regular attendees has been coming in, and we've been going through the process since Maxine is new to the meeting. And I really appreciate you taking the time out of your busy evening. So the Passive Investors Club, we've been focusing on passive investing. So I know a lot of investors are active. They're landlords. They own rental properties, or they own commercial buildings or strip centers. My business partner, he owns a couple condo units, some commercial buildings. But my biggest focus, and the reason why I've been so passionate about passive investing, is kind of trying to create a certain lifestyle, a freedom lifestyle, where we're able to own something, not have to do the work, and be able to make my money work for me, and just see how many times I can do that. So far we've done several meetings already. Our kickoff meeting, which kind of introduced this new way of investing or getting involved in commercial real estate. We went over evaluating sponsors, the people who will be potentially partnering with, that does all the heavy lifting for us, that does all the work to get these opportunities that we can invest and partner with. We also had the TribeVest CEO come on, which I'll explain that platform in a second, which is we just use that tool to put our minds together, put our capital together to invest. And we, of course, went through evaluating markets. I heard that you are invested in Florida, which is a great investable market, by a lot of different metrics. And then the week after, we went over part 1 of evaluating real estate, where we talked about cap rates and NOI and all of the glossary terms that you would typically see in a commercial real estate deal, so we can kind of get familiar. That kind of started our foundation, which now I wasn't able to make last week's meeting. So what I'm doing, I'm going to combine part 2, evaluating offers, and the investing process kind of all in one, because the investing process is pretty short. So when I was making my slides, I said I might as well just add that in there. It won't really take up much time. And if any questions at all, you can do a hand raise. Quinn will just field the questions, and then when I take a little break, I'll just answer any questions. But yeah, this is just an open session, as well as network with new people, getting to know each other, and hopefully very soon we'll be able to get together in person and talk about our goals and aspirations, and way we can be able to help each other and take our investing to the next level. So again, the goal was, which I had mentioned in the beginning, is to just build a community of like-minded investors. I know we have about 330 people that's on the group, and some are more active than others. And hopefully, once we start to open up more and be able to meet more in person, we can start to see more people. And it's been great doing the Zoom, because I met investors in the New Haven County area, Fairfield County, here in our Hartford County area, Bloomfield, Windsor Locks, all those great places. And what we're trying to do is just educate ourselves. A lot of times you join a group and they're saying, let's do this or let's do that, or they're selling courses. So this is 100% free. I get no benefit out of it outside of working with other like-minded investors and pooling our resources so we can grow together. And also another goal is just to get as many people that were interested in investing in real estate off of the sidelines and say, I want to start doing something and really make a goal of getting involved in at whatever capital amount it is, instead of saying, I'm going to wait a couple years until I get some more money or I save some more. So we kind of found a solution where we can be able to get people off the sidelines, get activated, and really take charge this year. And then for me, one of my biggest things is, as a also a serial entrepreneur, I own a residential and commercial real estate brokerage. So my income is earned income or ordinary income, and my goal is to turn most of that active income over to passive income, mainly for the tax benefits, because with the federal and state taxes, it's a big burden. And then when you convert over to passive income, which is the lowest tax category, you get to take advantage of a lot of the very successful wealthy investors do. And we're going to utilize those tactics as well, that are all legal and available to everyone. So why passive investing rather than, let's talk about buying distressed houses, fix and flips, things like that. Quick, can you just hit a pause for all people? And then, so yeah, why passive investing compared to us going out and actively doing it or wholesaling, which are great things, because like I said, I'm also a broker, so I do deals. I've done wholesaling deals in the past. I flipped houses. I own small rental properties. So I've done a lot of different things, and they're all definitely paths to wealth. But over time, as I built a family, and I do a lot of traveling with my wife. She's from Europe, and I just kind of want to build a lifestyle where I'm not constantly waiting on the next deal, or waiting on the next check, or waiting on the next small activity that requires a lot of my physical and and other different type of specialized knowledge to make it. And I feel like a lot of people in the group also feel the same. So really the big focus is just utilizing passive investing as a financial tool to build long-term wealth. Like I said, the tax burdens, to minimize that as best as possible, and to create that time freedom. That's the only thing that we can't get back. We can get back all the money that we lose. We can find other ways, but our health, our family, giving back to communities, that takes a lot of time. And I think utilizing this form of investing is a way that we can do that. So the tactic of doing that, because I had also mentioned early on, investing into large commercial properties is quite of a burden. So to invest into a 400 unit apartment building opportunity, it takes $50,000 to do that. So we kind of started thinking of ways on how we can possibly do this, and we came up with the quote group investing concept. So that requires us finding experienced sponsors that are boots on the ground, have experience in investing in these large type of projects, able to do all the legwork, and then kind of present it to us. We review it as a group and say we like it, we don't like it. And if we say we do like it, we pool our assets together, our capital, and we invest in those. And of course, it all starts with education. So we're going through this together. I'm always constantly learning new things, and my job as one of the group leaders is to just present information, and then whatever information we don't have, I'll go fetch it. Or if anyone else is an expert at it, they can pitch in as well. But I just want everyone to feel comfortable in the process of what we're doing, so everyone feels like we're all moving together, and it's not kind of anyone's being forced to it. I think this is going to benefit all of us, so I just want to kind of make sure it's a group thing and we're all learning together. I mentioned TribeVest. I keep bringing up this platform because it's just a third-party platform. It's no different than us really putting together a group of people, forming an LLC, putting together a bank account, and putting some checks in there and starting to invest. So TribeVest came out a couple years ago. It's a new company where they kind of thought of all of the process that a typical person will go through to raise money as a group, and they just put it all into an online platform. So just like how we're using Zoom, we're all using technology and we adjust. So now this platform came out. They don't take any part into the investing. They just allows us to facilitate our goals and ideas together. I also like it because it's completely transparent. You log in, you put your money in, you can see the little circle or how much you invested in. It has all the paperwork there. You get to communicate, you get to vote. It's just an easier way to have friends and family and associates and business partners to, put an idea together and start investing. So, and then we'll talk about that more in detail. Our first investor group has put together $50,000. We are currently looking at syndication projects to see which one's a good fit. We're going through probably 20 different deals that I looked through already. I have a list of over 130 different sponsors. So I want to make sure I look at them with a fine-tooth comb to see which one is good. And then, of course, we evaluate not just the sponsor, but the market, the deal, local stuff, every little thing before we, eventually pull the trigger, which we hope to by next month is where we're kind of our goal to do that. So the group started by doing $5,000 each. We got 10 members in the group. And so we're going to invest in $50,000. And again, we're going to look at a syndication that meets all of our criteria and goals, which that's why we're doing these trainings. And with that, even if it's $5,000 or $50,000 or 10 or whatever amount you come, or $1,000, you investing will allow you to own and be a part owner of, say, for example, 400-unit apartment or 1,000-unit self-storage facility. So it's better to own something rather than nothing. So that's kind of our process of breaking down the 50 into a more digestible amount and allowing more people to kind of join into the investing process. It allows us to have a smaller outlay of cash if that's something you want to do. So for me, I want to do 50,000 this year. I'm going to go spread that out into 10 deals or 5 deals. Instead of me putting the whole 50 into one project, I break it down and just do multiple projects, spreading out my risk, as well as kind of investing into different operators, markets, asset classes. So I'll be completely spread out. And I think we had a couple questions 2 weeks ago who had 401ks, from their job. And this is another great way to use, because you can actually use a 401k IRA, convert that into a self-directed, and then utilize your tax-free account to invest into syndication. So that's a really good opportunity for people who are interested in that. And I did have a couple, I think last year, I interviewed 2 IRA custodians. I did mention to them that I do meetup groups, and they're also willing to come on and do a brief presentation on the whole process so we can get more education on that as well. So this is just an example, and I'm just going over some of the slides. I know some of you that are already, been on the previous meetings have seen these slides before, but for the people that are new, that's why I'm doing it again. So this is kind of just an example. A deal came out a couple weeks ago. It was an apartment deal, 10.6% cash flow, 14.66 IRR. So this was just some sample numbers. And of course, these are all relative based off of that specific deal of what the numbers will look like. So 5,000 the first year invested will increase at a 10.6 average cash on cash return over the life of it until the sale. And then, you get your original principal back plus your cash flow and your profit distribution, which goes up to about $9,038. So almost 1x in your money. Why commercial? I mean, there's a lot of different things you can invest in. So it's the many benefits of going to large commercial as compared to smaller stuff. The very obvious is, of course, economies of scale, duplex versus 100-unit building. Of course, the tax benefits, you can get bonus depreciation. cost segregation that you can't do on smaller real estate. So, because we're doing this for multiple benefits, is of course the a larger multiple on your income, on your capital, but also the tax benefits as well that we're going to be receiving back. So you keep more of your money that's invested. Just kind of go a little bit more deeper into what I just said there. And of course, force appreciation. I know you can make improvements to a single family or a duplex and increase the value a little bit, but with larger assets where you can increase the rent, the asking rent for each unit by like say $50 if it's under market rent, reducing expenses, a whole bunch of different type of stuff, profit centers, so we can be able to multiply our returns and get a and of course investing into more recessionary proof assets. Single family and other different type of asset classes right now are suffering through the pandemic, but apartments, self-storage, and mobile home parks historically over all of the different market cycles have done very well, and it also proved it through this pandemic as well to have increase in demand, but also continue the cash flow. So for today, we're going to talk about the business plan for these sponsors, talk about the investing process, and then kind of the part two of the evaluating real estate. And I kind of combined it. And there's not a tremendous amount of slides. I won't take up everyone's time. So a sponsor, they have a different, a certain investing strategy based off the types of stuff they want to do. You have core plus, value add, and opportunistic. So core is more very low risk, stable asset class, more like a single tenant Walgreens property where they have a 25-year absolute triple net lease. Walgreens is a investment grade tenant. So that's a very low risk, just a moderate, the lease is in place. It's with a large publicly traded tenant. So some people invest in those deals. Core plus is just a slight add of value to it, which could be just maybe the changing of the property manager, but no really improvement like changing or improving the units. Value add is what we're going to be focusing on, where we're going to be looking at properties that are stable, cash flowing, but is either under market in rent or can have significant improvements. You can add multiple profit centers, things like that you can significantly improve the property and improve the net operating income, which is equals to our profit. And then you got opportunistic, which is like ground up development or like major large rehab projects that are very high risk but also high reward. So I like the value add because, like I said, you get to multiply your capital, and if you're investing in stable properties that you invest in from the get-go, that cash flow is already existing in the property, and we're just making the strategic improvements in order to maximize the value of the property. So for some of those, we will favor what they call low-hanging fruit deals, where when they buy the property, there is room for improvement. So the rents are, the landlord owned it for 10 years. He never raised the rents on the tenants, or he had a property manager that wasn't aggressive and they had tenants in there that were dragging down the income, or there's some more space on the lot where they can add some more units, or there's a significant amount of upgrades they can do. So you have to identify and find a very experienced sponsor that specializes in those types of deals. And then there's also opportunities in these easy, fast improvements that don't cost much capital and overhead costs. And I'll talk about those in details. And that all leads to force appreciation. So when you're increasing the rents and decreasing the cost very aggressively, you're able to just increase that value of that property compared to other assets where you really can't have that opportunity. So for our first example, multifamily value add, some examples of doing that, of course, is, like everyone knows, getting a better property manager, being more aggressive with the tenants as far as rent collections and getting good tenants. You can do ROOPs, which is just residents that are billed on a monthly basis based off of their utility consumption. So like, the water and things like that. Then of course, renovating the units, you have to kind of look at the market and see, okay, the comparable apartment buildings in the area all have wood floor. So we're going to put wood floor in our apartments so we can be able to ask what rent they're asking and then improve the property. So little things like that is all part of the business plan that the sponsor must do prior to approaching investors like us. Then you have a community improvements, like adding a dog park or fitness center. So then when people are looking to move or they're looking for a new place, they say, well, this place I'd rather go because they accept dogs and they have a dog park or another type of amenities that just makes it more attractive for them to stay there. So right now, not a lot of people are going to actual gyms. So maybe having a gym at your residence is a good thing. Or you have a birthday party, you have a clubhouse, you can utilize the clubhouse. And of course, getting aggressive on expenses. I interviewed a top insurance broker a couple weeks ago, and he talked about the many ways you can get different types of improvement on rates on your insurance and working with the right broker. And of course, utility and efficiency, getting a new boiler system or a gas unit system that's more efficient, changing from oil to gas. There's so much different things you can do that will improve the property over the long term when you do all those things up front. And of course, like storage, covered parking, fees, common space rentals, concierge service. So there's just a lot of different things that you can do compared to, like a smaller unit, like a 1 or 2 unit property. Here's a couple of things from self-storage, which is extremely exciting because I didn't realize until a couple months ago when I interviewed another top sponsor. I think they're out in Texas and they own thousands of units, and the things that they do to their properties, I was like, it's just amazing. So things like adding storage units, vertically or horizontally, depending on, of course, the zoning laws, but there's a way to adding more units on your lot. There's a whole bunch of profit centers you can do. You can sell insurance, boxes, locks, tapes, dust covers. You can, charge for record and wine storage. And I know local municipalities, they use storage centers for like their paperwork and things like that. If they have additional, or if you're an attorney or you're a CPA, you just have so much paperwork in your office and you can just move it to a nice, secure 24-hour locked unit, and then you can be able to utilize that. U-Haul rentals, they got boat and RV parking, billboards, cell phone towers, propane filling and so on and so forth. There's just so many different profit centers that you can improve the property and just maximize it to the max, squeeze every penny out of the property, and all those profits goes to the investors. So this is just an example of just kind of some small ones. I had mentioned earlier about the favor for improvements that don't require a lot of capital or labor. So things like, the pet fees, or if you got some storage units, you can just, utilize your part of your clubhouse and start making some storage units there, or adding concierge service or something that you can add that is quick and doesn't take a lot of labor on the sponsor's part. So for example, here, we start over at $2,800 that we're already collecting in pet fees, $3,750 in garage fees. So we're getting around $6,500. Then we made some improvements by bumping up the pet fees or collecting more. Now we got $6,000 compared to the $2,800. And then garage fees and then other fees as well. So with that, just adding that those little improvements, we're able to bring in almost $5,000 in additional income each month, which accounts to almost $60,000 a year. So if you look at it from a valuation perspective, and then you add it to the total value over the life of the investment, this particular example, you can increase the value over $1 million. So assuming that you're selling at the same projected cap rate. But just these little small things just makes a huge difference. And so that's why I'm very excited about value add and investing in commercial and getting involved in these deals compared to us constantly thinking small and say, look, let's invest big into these deals because these have huge potential. So now let's switch over to talk about as a passive investor, what affects our returns. So once we make that $50,000 investment, there's a whole bunch of things that can affect the overall returns. But before I get to this section, Quinn, do we have any questions so far, or everyone's good to go? I'm assuming we are good to go. All right, so I'll just wait to the end. And so continuing on, so we have a hold period, which is how long we hold on to the property. On average, a lot of the sponsors that we've been looking at are between, let's say, 3 to 7 years, and they're more of a buy, hold, and see. So meaning they'll buy it and they'll kind of watch the market, and they'll have a target sale date around 7 years, but they're going to constantly look at where interest rates are at, where's the market, how's the demand coming, and have we completed all of our business plan elements. Then you have the type of debt that you have. You have 65 loan to value, 75% loan to value. That makes a difference into the returns back to the investors. The financing terms, interest rates, is it a floating rate? Is it fixed rate? Then we have rent growth in that local market. Is the sponsor conservative enough to say, the rents are $50 below market? Are we able to increase that? So we got to make sure those projections are realistic. And this is all, we're presenting this because when we look at these opportunities that these sponsors send to us, we want to make sure that we have enough general data to say, this is a little bit out of the norm, or this is a little too aggressive, which gives us pause and give us to ask questions, and also, makes us more as an educated investor to make sure that we're not just jumping into the sexiest looking deal. We want to make sure that all of the elements look good before we pull the trigger. And then what about their capital expenditures? How's that scheduled out over the course of the hold period? What are they charging the fees for things like that? And of course, their sale exit cap rate. So what are their projections? Is it realistic? And we'll get into that in detail in a second. So go for the hold period. So a lot of these sponsors that we're looking at are typically in that that 3 to 7 year window, typically in the 5 to 7 year range, which gives them enough time to do what they have to do with the property, implement all the plans, and kind of implement all of the tax strategies, and kind of it's more of a longer term, and it's better on the cash on cash return. So for the shorter term, there'll be some deals, and I'll send over a couple examples when we get them, for some sponsors where they'll see a play of buying a very distressed asset, doing major renovations, or even ground up development, and just quickly, not really flipping it, but then selling it very quickly in a short period of time, say 1 to 2 years, to another end buyer, which then also take some more of that improvement and then kind of take it to the next level. So there's some sponsors that specialize in that, and if that's something you like, you can do that. The benefits is it's higher returns, and of course higher IRRs, but with that is higher risk, because you're dealing with large rehab budgets. Potentially there may be zero to little cash flow during that period, because they're using the budget to renovate, and there's no tenants they're paying. So that's something that you have to evaluate to see if that's something that you're comfortable with. The things I like and what I kind of subscribe to and suggest is invest for cash flow, because we can never really project how the market is going to be in the long term, especially like having a pandemic just drop on us. That wasn't expected. We do kind of have historical data on how market cycles are, every 8 to 10 years, where interest rates are and things like that. We have a little bit more data on that stuff. But overall, we should always be considering to invest for cash flow. So and just really about how many times can you do it, and focusing on the other potential benefits as well, capital preservation, cash flow, and tax benefits. So with the long-term hold, we have potentially better measurements on our cash on cash return because we're holding long-term, we're implementing the business plan, we're increasing rents over time, we're reducing expenses. And then that thing I had mentioned is that we're not dependent on a short-term market cycle. So we will wait, evaluate the market, and if we have some nice financing on it, we can be able to ride out if it's not a good time to sell. And then when it is the time to sell and we met all of the check boxes, we make the sale and then we profit off of that sale. So for leverage and the debt, this can, improve profits or magnify losses depending on the performance at when we sell, as well as how they structure it, with rehab and things like that. So for example, here, this is a $10 million purchase, and you can see with all of the renovation budgets and all that stuff, this is a 65% loan to value with a 4.2% interest rate, 30-year amortization. So if we look at the numbers here, that is 11.2%. So that's right in the middle here, 6.5, and then we have a 65% LTV. So if you see if the property did not perform well and end up selling it at an 8 cap, so meaning the higher the cap rate, the lower the higher the lower the value. So you can see it's like 1.8%. And if we had a higher loan to value at 80% and we end up selling at a 5 cap, we do okay. But on the flip side, if we didn't do the right thing, it actually loses money. You can see negative 0.1%. So that's kind of something that we have to really look for in a sponsor to see if are they conservatively underwriting their property, what's the whole situation with the financing, because that's very important, because assuming they do all the right things, but we can't expect things outside of their control to happen, which can significantly affect the project and of course our invested capital. And now financing terms, I just kind of touched on that a little bit. So you have a fixed interest rate, and you have floating variable interest rates. We have interest only period, and then our amortization period. So starting with the fixed interest rate. So right now interest rates are at historical lows. So a lot of sponsors are taking advantage of that and locking in rates, assuming that with all of the stimulus and all of the different spending that we're doing in the economy, that interest rates and inflation is eventually going to rise, and the cost of capital is going to increase. So a lot of investors want to kind of lock in long term, and plus, as a conservative investor, I like to know, like, okay, we got the lowest interest rate we can get right now. We can kind of forecast our projections a little bit a lot better, assuming that our NOI is in check. With the floating, it's what it sounds like, is the interest rate floats. The benefit is sponsors like this because this is typically lower than the fixed rate loans. So if we're dealing with 4% fixed rate, this may be at 3% or 3.5%, for example. But the cons of it is that this is based off of the treasury, where it will increase or drop. So it can vary, and I think that either goes every month or every 6 months. So this is assuming the sponsor is making a bet that the interest rate will actually decrease, which then will improve the overall performance of the property based off of the NOI. So assuming they would assume everything will go down lower, but on the conservative side, more people, I would assume, would be leaning towards more of a fixed interest rate. But then we take this on a deal by deal basis. Then we have interest only periods, where the lender can set up where it's only interest only payments with no principal for a period of time. Usually it can be 3 to 5 or even 10 years. But the caveat is we have to make sure that even though it improves our cash on cash return for that period of time, the sponsor must have a strong plan to increase the net operating income before the principal payments are due, because they now significantly impact the project. So So it's a good thing to have interest only, but you have to make sure that you have a plan to increase the rents, or make sure all of the renovation projects are done and have a significant improvement to the property that increases the NOI. And of course, amortization is just a simple payback schedule. So a lot of times you see it's 25 years or 30 years where they amortize that loan. So the shorter the period, the higher the return, or the payment. So we talked a little bit what affects the returns is the rent growth. So assuming the sponsor that underwrote the property, they did all of their research on the local market. The average rent per unit is $800 per month, which is under market, where the other units are renting for $950. So we have $150 of potential gain from the property that we have now. So we have to make sure that it's in line. And of course, they'll send us comparable data. Most, I would say 99% of the time, they send that with the package that we review. But also, we can do our own research. We can find it through like Marcus Millichap, Colliers, all these different national research firms that can be able to get data. We can be able to confirm it. We can check like on apartments.com, just to do a little bit more extra due diligence to make sure that their projections is somewhat conservative and that they can actually hit these drivers. And of course, looking at it from a macro perspective of, is it a desirable location? Is it increase in population? Does it have all of the economic drivers to bring in businesses so they know they have good supply and demand in this market? The capital expenditures, which is just the money they're going to use to improve the property, like renovating the units, fixing the pool, fixing up the courtyard, adding dog parks, adding these different amenities to the property. What can affect our returns is if they don't do it properly on time, or they go over budget. So delays in timing, if they plan on increasing rent in year 2, but then something ends up happening where they couldn't raise rents, that can significantly impact the return, especially if they have a 5-year project window or things like that. Then you have budget, which sometimes things are unexpected and you end up spending more than you accounted for. So then you have budget overruns, or you have material costs are end up spiking. So a lot of the times the sponsors will put together a budget contingency, which is maybe a couple percentage points to the budget. So in case things like this does happen, they'll be able to be prepared and not go back to the investors to do additional capital calls, which is just asking investors for more money because they didn't budget properly or something went over and they need extra money in order to continue running the project effectively. So the exit cap rate, so they did all their project and they plan on a targeted sale date. And that kind of accounts what we evaluate the property based off the cap rate. So I put this kind of example here of a hold period and where we expect the cap rate to go. So ideally, when we're underwriting, we would like to add in a little bit of increase in the cap rate when we're planning on selling it, so we can have some more realistic numbers. And all of the sponsors that I evaluate and looking at a lot of different deals, 10 basis points is really a very conservative number per year. And that's assuming, interest rates and things like that is always going to rise. So that's why we always add in those numbers there. So we want to make sure that we're looking at these figures, and then we're also crunching our own numbers to make sure that it's realistically aligned, so we can make sure that how much is going to affect our numbers to see if this is an investment for us or we're going to look at another deal. Now we talk about sponsor fees, which are already built into all of the metrics, but I want to kind of go over to what you expect. So when you get an operating agreement and a PPM, and it's going to say all these fees, you can say, what's this about? So this is a typical fees that what a sponsor does in a syndication. So you have the acquisition fee is pretty much the work that the sponsor does and flying out to the property, doing all the acquisition, getting the attorney together and the cost segregationists and doing all the work. So they'll typically charge depending on the size of the deal. So usually the larger the size of the deal on the lower end perspective, and the smaller size will charge at the higher end of that amount. So that's between 1% to 2%. And that's typically a one-time fee on the purchase price. Asset management fees. So of course, this is separate from the property management, but this is the overseeing the whole process, making sure things are done on time and just making sure everything is going smooth, putting together the reports to send to the investors and keeping things up to this. So they're just being the stewards of the property, making sure everything is going as planned. Then they have their local boots on the ground property manager. Some of these sponsors have in-house property managers, and some of them are using third-party property managers. So we want to make sure which one of those are they using, how the fee structured, but typically that is a 3 to 4% of the effective gross revenue. So whatever the revenue comes in, they're going to take that 3 to 4% off the top, which is to do all of the labor of overseeing and managing the property. Then since they're all value-add properties, we're dealing with some type of construction component. So they're going to be renovating units. They're going to be making some changes or switching out things. So typically this is 4 to 8%, depending on the size of the project. But this will be the total capital cost of the project of this project, or just their hard costs, which is just labor and materials. Then when they get ready to sell, not all, but some sponsors charge a disposition fee, which is preparing everything for sale. So getting all the paperwork done, working with the attorneys, getting the broker agency agreement signed, just doing everything possible and ready to get this property sold, and then return the capital back to investors. So this is also a one-time fee, typically 1 to 2%. And this is in addition to the broker sales commission, which charges 2 to 4%. So this is just an example of how it looks on a spreadsheet, all of the fees. So if you look on the bottom left, I just put a little note here, acquisition, construction, management, construction, asset management, and disposition fees. You can see all here. And if anyone wants a copy of this spreadsheet, I'll shoot it over to them so you can kind of just play around with some of the numbers. So it's good when we get a package, we can go over it together, start playing around with some numbers, which they call stress testing, to make sure that the sponsor is doing their due diligence to make sure that it's really conservative and realistic. And then also we can then look at it from our return perspective. So if this is with all the numbers that they put in, which we assume will be conservative, we trust the sponsor, and the average cash on cash return is not where we want it compared to another deal, then we're able to now compare apples to apples and see which one actually will be the better fit for us to invest in. That's why we like to play around with the numbers, along with looking at the stuff that they send to us and not just fully relying on what they send, but also running our numbers to make sure that it makes sense. So the investing process is pretty much us deciding that we like it. We commit to a soft reserve, meaning we express interest into the opportunity. We let them know, okay, we're going to think about doing $50K in investment. They'll send us over the operating agreement, the private placement memorandum. We review these documents, fine-tooth comb to make sure everything looks right. So the operating agreement is just agreement with all of the investors and the sponsor, everyone that's involved in the property that will be investing into the limited liability that will own this property. So we'll be a co-owner of an LLC that owns the property. So the operating agreement will have what are the rights of the members, meaning voting rights and things and all that stuff, like what is the plan with the property, they'll talk about the profit splits. It'll go again the fee structures, and then we sign that and send it over to the sponsor. The PPM is pretty much a full disclosure, and this is regulated by the SEC to make sure it discloses everything that can possibly humanly go wrong with the property, all the legal liabilities, the disclaimers, everything is explained in there, the risk of loss. So everyone's on the level to make sure everything is fully disclosed. Investors are informed. And so this is just another added layer to make sure that everything is all in line. Okay, and then
The rest of the peanut butter shake, spread. Don't act like you're scared of the bread.
And so next, once we make that investment and then we're actually into the investment, we'll be looking at our distributions and our property report, which usually will come out either quarterly or monthly. Usually distributions are quarterly. So, and usually the property reports are monthly. They'll just kind of let you know what's going on with the property, is how many people will lease the property, leased in the units this month, how many people we kicked out, updates on the construction projects. We renovated 40 units this month, and we have another plan to go. You know, the variances from the budget, did we go over or did we go under? Normally they won't let you know if it's based off of on the budget and they're on budget. They'll kind of show you the spreadsheet, but they're not gonna make an alarm about it because they're doing what they said they're doing. But it's just a variance if they end up going over, and why. Then they'll usually give us a local market update that, you know, market is nice. We're able to achieve our asking rent projections still. We see other units in the area renting for these asking prices, and we feel confident we can do that as well. And of course, distributions, where they'll send out the cash flow, either a check or direct deposit, as well as the time when we're ready to do the sale or the refinance, and then we get our actual proceeds back to us along with our original investment. So if anyone has any questions, this is just a funny picture of a kind of fire hose to the face, because sometimes a lot of this seems like it's pretty fast and furious. But if there's any part that you want me to go over again or kind of explain, and I'll make sure to send out this presentation, put on YouTube, and you can just access the replay, and you can give me a call anytime to go over it. But again, I'm just being a steward of just providing information to everyone, so everyone feels more comfortable and understand the process. Because and I wish I knew early on, but I didn't. You know, I started learning about syndications a couple of years ago, but wish I knew this early on, so I can kind of get more involved in these deals. And now that I talk to more and more investors, they're not even familiar with it as well. So I'm glad that we're actually talking about this subject and, you know, getting more people potentially interested. So Quinn, do we have any people that have any questions? If not, then I'll just stop the share screen, and then we can chit chat for a few minutes, and then I can wrap it up, and we can talk about what we're going to be working on next.
Yeah, so Mark just joined. If you don't mind just going over with that a little bit.
Okay, so did he come in towards the end?
Yeah, he just got on.
Okay, yeah, so thanks for coming in, Brother Mark. So yeah, we had just went over the concept of passive investing compared to active investing. So today we just went over kind of a combination of evaluating offers from sponsors, as well as what affects our investment returns when we make an investment, and just kind of touched on some of the bullet points of the previous meeting of the kind of the financing, the measurements as far as like cap rates and NOI and things like that, improving the property, things, the business plan, things that sponsors do to bring out as much value to the property, so we can be able to suck out as much juice out of the property and make sure that it's a good investment. Let me just pop in here. I think got a question. Will investors expected to pay the fees you talked about? So good question. So no, all of that is already in their numbers. So when they said they're going to pay a 10% cash on cash return, all of the fees are already taken out of that number. So there's no extra fees outside of your original investment. So if you invested 50,000 into a syndication, that's all you're paying. There's no extra fees. There's no annual fees. There's no nothing. So it's whatever the projections of the cash on cash and the IRR is on your 50,000, and that's what you get. So that's a great question. So I'm glad we cleared that up there.
Okay, thank you.
Absolutely. And nice thing it is, like I said, getting into one of these syndications at minimum, I think the lowest I seen was 25,000, but on average they're between 50 to 75,000 to invest in these. So that's why we're kind of structuring these meetings, educating on the process, and then utilizing a platform like TribeVest to invest into one of these projects and just really just take advantage of all of the stuff that's out there. And then to kind of further go into Mark, maybe I could just pop back into just a couple slides, because I know that we just went over everything here. Let me just pop back. So Mark, just to kind of break it out to a nutshell. So we're, as a group, the Passive Investors Club, we're just putting together our syndication group, which is just a smaller group of us. We're going to be investing into an LLC together. Our first tribe group, we invested $5,000 each. We got 50,000 available. And then we're right now reviewing sponsors that we're going to invest in. So I already looked through about 30 offerings right now. And there's sponsors coming up every month that are reaching out to me. They're saying, hey, please take a look at our deals. So right now we're just slowly doing it, but we're also utilizing our first group as a trial group, so we can show everyone else in the group the whole process of us doing it. They can kind of see it in action, and then we'll be able to report back, like, here's our monthly cash flow check, here's our K1 statement, here's our monthly reports, this is how it looks, this is our experience, we like it, don't like it, thoughts, so we can answer questions and things like that. So then now people can start forming other smaller tribes, and we can start investing into multiple deals. So with that, with the TribeVest, we can crunch it down to smaller segments. We have members who have made an interest in doing 1,000, some 10,000, some 25,000. So it's really whatever your comfort level, but just allowing the group to finally just take some action. And another cool feature about TribeVest is that if you wanted to set a goal of investing 5,000, you can connect your bank account in there and have it draw from it, either weekly or bi-weekly or monthly, or if you've got a W-2, and you can have it just come out of that account. So you can be able to kind of have a goal. And then once we reach that funding amount, and then we already done our homework on the different opportunities, at least our money is ready to go, so we can pull triggers on, very quickly, because some of these syndication opportunities go very, very quickly. Some of them in just a couple of hours, they end up filling up. So it's kind of ideal to have the money ready, which is everyone has access to the account. So it's not like it's sitting in my account. It's a group savings account. Everyone has access to it. If you happen to change your mind, you can pull your money back out of it. You can't pull other members' money out of it. You can only take yours. It's in a FDIC insured bank account, because TribeVest only facilitates as a third party. They just put together the system so we can be able to use it, and then we have to pay them a fee for the amount of effort they put into putting together this system. So it's like I said, we can go through the demo. Actually, the CEO did a presentation, so I can send out that presentation to you, and you can also demo it. And then also, to make a point, this system is not exclusive to me or our group. If you want to go find a bunch of investors or family or friends and say, hey, let's get together, invest and buy an Airbnb or we can buy some land, or whatever you want to do with it. You can be able to use it as a nice platform to just get like-minded people together and organize the funds instead of knocking on everyone's door and say, hey, where's your check and all that stuff. So just an easy, transparent way of doing business in the 21st century, pretty much. So we have
Now with sponsors, how many sponsors you're saying, like, what are some of the names that you have reaching out to you at this point?
Right now it's Milton, and then we have Ricky, we have Tara, we have a couple of people that are my business partner, and a couple others that already put together the investment for our first deal, and then a couple other people I just expressed some interest. But we're putting together this first tribe, make the investment, and then once more people feel comfortable, then we can be able to put together more tribes at any point. So anytime we can do it, we can start up other secondary and third buckets for group investing.
Okay. And how many investors do you have right now? You said 5?
No, we got 10. So we got the first one is 10. So we got 50,000.
So that's 50,000 already that year? So everyone put in 5?
Yep. Yeah.
Okay.
Yeah,
Now,
first one.
and you can put in more if you want.
Oh yeah, absolutely. Because it's pretty much you're just a part owner of the LLC. So if you end up owning, say 30%, and then 70% is left for the other investors, and then somebody puts 1,000, someone puts 15,000 or 18,000 or whatever it is. It's really whatever is up to your comfort level. But I kind of like it because then I'm able to now invest into multiple deals with the members. If I have like 50K that I can deploy or whatever, or I can just put 50K in one bucket, and then everyone can add on to that, and we can also invest that as well. It doesn't have to be the minimum as well.
Okay.
So it's pretty flexible.
Okay.
Absolutely.
So I'll end up talking with you or Q later offline, so you guys can send me some more information. I go through it and go through some things. And I'll be back in contact with you the latest tomorrow, and I'll just let you know from there.
Yeah, and then we can chat on the phone, and like I said, we can any of this whole stuff. I have we did the recorded presentations and all that stuff, but
yeah,
a lot of it's pretty straightforward, and you're probably familiar with the process of doing it. But it's just like I said, just an easier way to get the minds together to do it.
Okay, that's cool. I understand.
Absolutely. So let me just think with the first investment tribe, how is the first project going thus far? So we are still evaluating sponsors. So we looked through about almost close to 30 deals, and a couple of them already filled up already. So we're still looking. Our goal is to have the deployment in probably first or second week of March. Definitely March. The money is already available, just finding the right opportunity. So once we make that, we can do another presentation and say, this is the deal we're going to invest in. Here's the numbers on the deal. This is the reason why we like it. And then take you through the whole process of sharing the PPM and the operating agreement doc, so you can take a look at it as well, until we finally, send over the check or the wire transfer over to them, and then we'll do the updates each quarter when we get our cash flow checks. Because once we do the cash flow checks, so they're going to write a check or the direct deposit to the LLC. Then we will then do the distribution to each individual member based on how much capital invested. So for the first group, it's going to be even because it's all the same 5,000 each. So, but we'll make sure to show all of that process as well, so everyone kind of see behind the scene what the whole process is, so everyone feels comfortable doing it. Okay, response received. What is the fee amount and what is it based on? So the fee, if I get you correct, you're referring to the fees from the sponsor. So those are just the fees that they do for operating the investment. Let me go back to that slide real quick. So you have acquisitions fee. They charge that when they acquire the property. So they go out and, because the way a lot of these apartment properties go, they do like best and final. They have to go out there and evaluate and do their inspections. So it takes a lot of money and travel time and effort to actually go and acquire the deal. So in essence, it's kind of reimbursing them for their fees and for their time and money that they spent on the deal for that. And that's just typical for sponsors. Asset management is just overseeing the whole entire project. So they're making sure they're talking to the leasing agents, the property managers. They're getting updates on everything. They're just making sure everything is completely smooth. And then they also put together our paperwork for, for the property and make sure everything is compliant on their end. Property manager, the person local on the ground to make sure everything's going fine. And that's the typical fee for a larger asset class, like a 100-unit apartment, 3 to 4%. And then all of them are going to be looking at value add properties anyway. So there's always going to be a construction component to it. So they're always going to charge whatever that actual project costs. Sometimes it's like $100,000 that they're charging or that they budget for renovations. Then they take 4 to 8% of that, or the hard cost, which includes the labor and materials. And then when they get ready to sell it, they got to coordinate with the exchange accommodators and the title companies and deal with the brokers and a whole bunch of back and forth with the attorneys. They charge another one-time fee of 1 to 2% of the gross sale price. So all of those will be in the operating agreement when we review the deal to make sure everything looks good. But these are just standard numbers that you will see in probably 99% of the offerings that we're going to see. So the taxes, so we're going to get at the end of each year, we're going to get a K-1 statement for our own portion of the property. So that means we'll get that K-1 document, and then that one we use to send over to our accountant for all of the proper tax documents and things like that. And you as the part owner of the LLC, you'll get your separate K-1 statement as the part owner of the LLC, which owns part of the syndication.
So will that all be done by TribeVest?
No, that will be done by, we get a separate bookkeeper or accountant to do that.
Okay.
Yeah, so but the original K-1 statement will be sent from the sponsor to us, but then since we'll be part owner of a secondary LLC, we'll just be able to kind of, whatever portion you owned of the entity, you would just reflect that on your K-1 statement that you'll give to your accountant.
Okay, thanks.
No problem. And then TribeVest fee. So every time you set up a tribe, it's $400. So it's just the fee for them to access the platform and bring all the people together. And I think it's very nominal because that also includes the formation of the LLC. So the cool thing about TribeVest is that you sign up, and then you go in and you bring in all the investors, and then you say, I'm ready to create my LLC. You click a button and it automatically connects you with, well, it does all the work for you behind the scenes. So if we're creating an LLC in Connecticut, it will go through the Secretary of State website. It will start forming that paperwork. And then part of that 400, it minuses out the actual LLC fee for Connecticut. I think it's 130 or 160 or something like that. So it minuses out. So it's really like nominal fee for using the platform. Again, we can do this on our own. We can go create our own separate LLC and doing all this stuff. But as a point of transparency and people kind of get to see and an ability to connect your bank account and all that stuff, I think that's worth it. But again, it's something that you could do directly, but so that is just a fee, which I think is very reasonable. I would expect them to charge more later on because it seemed like that's kind of cheap to me, but so may as well take advantage of it if it's there. So awesome. So yeah, that's like kind of the gist of it, of this one. I kind of included the investing process in this presentation because I think this was the last one of this series, and then I didn't get an answer back from one CPA that I wanted to get, so I have another one that I also interviewed. I'm going to ask him to come on and find an appropriate date, maybe next week or the week after, to talk about taxes and investing in commercial real estate. So he'll break down all of the benefits, because I know a lot of the people that I talk to, they're paying little to no taxes and they're getting consistent monthly cash flow. And it's just like all of the many benefits that are available to us that we can take advantage of legally. We just got to make sure how we be able to access it. And then also utilizing investing to offset some of our active income. So there's a whole bunch of different type of stuff. So when I get a date, I'll shoot it out to everyone. And then whatever questions you do, we can maybe turn it to more of a Q&A for him. And then he can do like kind of a shortened presentation to kind of give us the overview of how the tax system works and how we can take advantage of it. And then also get another date for the IRA custodian, which can talk about if anyone who has IRAs or 401ks to utilize that to convert it over to a self-directed or checkbook IRA, to use that into to invest in the syndication also. So the LLC will be just a standard LLC, not a C Corp that we would use. So we'll have the typical protections and then all of the general pass-through for the taxes. But I'm not maybe there is some advantage for the C Corp or S Corp, but most of the properties that are acquired through the syndications are LLCs. And then most of the people who use LLCs to invest in them normally use LLCs. But there may be some other advantages, I don't know, but maybe that's a question we can send over to the accountant so we can kind of make sure we're fully informed. I would love to know that as well. So that's a great question. Thank you. But yeah, the question was, how would LLC be taxed as S Corp or C Corp? So very great questions. So yeah, so great. So I'll set up the meeting for the next couple weeks. I'll try to get the firm date for the accountant, and then as we get closer to securing an opportunity for our first investment, we'll do another presentation. We'll kind of go over, okay, we're going to invest in this deal, look over everything together, and if there's stuff that needs to be highlighted, we'll do that, and just kind of take everyone through the process. I think it'll be a nice learning experience, and we all learn together, and hopefully everyone feels a little bit more comfortable as we kind of went through a lot of this stuff here. So beautiful. So if any other questions, or and since I think I recorded this properly without showing everyone's face, I'll put this on YouTube so everyone has the link. I wanted to respect everyone's privacy on here, so I'll let you know when the link is up. As soon as this downloads on my computer, I'll upload it to YouTube, and I'll send out the link so I can so everyone getting access to it. So for people that came on late, and also has all of our previous meetings as well that we did, especially like our kickoff meeting and things like that. So. All right, beautiful. Thank you so much, friends and family. I really appreciate it again. Thank you, Quinn, for moderating and getting things organized. And I'll see you guys soon. So I will work on tomorrow getting the dates out for the other meetings for the taxes and all that other stuff. And if there's anything I missed or didn't present well, please let me know. I'm always open to feedback and want to just serve you all well and just get the information over so we can all really get some things going this year and really take some action. I think we got a good group of people, and I think we have a lot of potential. There's a lot of opportunities out there, and we might as well take advantage of them and make it happen. So I appreciate it again, friends and family. I'll talk to you guys soon, and again, I'll inform everyone once this is live. I'll send out the link, and look forward to talking to you guys soon, and hopefully in person. So I look forward to that. All right, take care, friends.